Today we are covering annuities for the Series 65 exam, focusing on the key distinctions between fixed, variable, and index types. The exam will test your understanding of the two main phases of an annuity: accumulation and annuitization. The accumulation phase is the growth period, where you are putting money into the contract and it grows on a tax-deferred basis. Think of this as the savings and investment stage. The annuitization phase is when you convert the accumulated value into a stream of income payments. Once you annuitize, you trade your lump sum for a series of periodic payments, and the number of annuity units you receive becomes fixed. A critical exam point is understanding the risk profiles of different annuities. For a fixed annuity, the insurance company assumes the investment risk, guaranteeing a minimum rate of return. Because the owner is not subject to market risk, fixed annuities are not considered securities. In contrast, with a variable annuity, the owner bears the investment risk. The account value fluctuates based on the performance of the underlying sub-accounts, which are essentially mutual funds. This exposure to market risk is why variable annuities are classified as securities. Indexed annuities offer a middle ground. Their return is linked to a market index, like the S&P 500, providing the potential for higher returns than a fixed annuity, but they also offer a guaranteed minimum, protecting the principal from market losses. Because the insurance company still guarantees the principal, indexed annuities are not considered securities. The exam frequently tests the tax implications of annuities. A core benefit is tax-deferred growth, meaning you don't pay taxes on the earnings until you take withdrawals. For non-qualified annuities, which are funded with after-tax dollars, withdrawals are taxed on a last-in, first-out, or LIFO basis. This means the taxable earnings come out first, before you can touch your tax-free principal. This is a common exam trap. In contrast, qualified annuities, funded with pre-tax money, are fully taxable upon withdrawal. Another heavily tested area involves penalties. If you withdraw funds before age 59.5, the IRS generally imposes a 10% penalty on the taxable portion of the withdrawal, on top of ordinary income taxes. Additionally, insurance companies impose surrender charges for early withdrawals during the surrender period, which can last for several years. These charges are typically a percentage of the withdrawal and decline over time. To remember the key annuity phases, think of the mnemonic AAP: accumulation, annuitization, and payout. First, you accumulate the funds. Then you annuitize the contract to create an income stream, which leads to the final payout phase. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.